In this week's video, we'll review the latest charts, data sets, and studies to help us better understand the keys to a massive week for bulls and bears. We'll be moving quickly, so feel free to use the pause button on your video player. We'll start with charts from Friday's session, and then we'll shift gears to numerous studies, and then we'll end the video with reasons to be concerned heading into CPI. Had quite a bit of volatility intra-week this week. How much damage was done to the charts? The S&P 500 chart shown here was included in a tweet earlier this week. It said the primary S&P 500 bull-bear battle zone was between 4090 and 3900-ish. Thus, if you're a stock market bull, you're hoping price, if it comes back into this area, will make a stand. And if you're a bear, and bearish concerns would increase. If price ends up down here, the longer it stays there, the more concerned we would become. This chart stated February 8th. How did we look at the end of the week? As of the close on Friday, February 10th, made a stand at a very logical level. It closed at 4090. Thus, given what we know today, no serious damage to the bullish case or the rally attempt off of the October low. It's been a week since the unexpected and extremely strong labor report from last Friday. Thus, a fair question to ask and answer. How much damage was done to the charts this week? The chart that we covered in last week's video of the S&P 500 equal weight RSP in the ETF world. And remember, we said the look of the chart is based on knowns and expectations about the future on numerous subjects, including inflation, Fed policy, interest rates, and growth. If we fast forward to the end of the week, how much different is the read relative to the net aggregate opinion of all market participants regarding all subjects on all time frames? Short answer is, it still looks very good. In fact, this is a trend coming back to the 20-day moving average and thus far making a stand. As we mentioned last week, if expectations change and the knowns change, then it's possible the chart will change. That may happen very, very soon. Hasn't happened yet. Another fair question to ask and answer. How unusual is market volatility after a major low? If this is a major low. Is that concerning? Well, not really. These are major lows in 2009 after the low, 2016, 2011, and 2020, and you can see there's a ton of volatility in these anecdotal cases. There's still a lot of pessimism in the air, including data point down here that's similar to 2009. So with a major inflation report in the form of CPI coming next Tuesday, let's talk again about what would the bears like to see and what would the bulls like to avoid. Since markets operate in fractals, this is a small fractal of what the bears would like to see next week. This is Thursday's session. We gapped open up here, and for the most part, we're in a 1-minute downtrend the entire session. Friday's session here in the green box was much, much better. We're longer-term investors. Why is a chart like this potentially relevant? Because there are periods in history when the net aggregate opinion shifts. It's very, very possible that it shifts in an abrupt and violent and lopsided manner. There's the COVID plunge here, back to back to back to back to back. This is what the bears want to see next week. This is what the bulls want to avoid. We want to be prepared for both outcomes, keeping an open mind. Trade the chart in front of us and are allocated based on the chart in front of us. Right now, it still looks fine. Let's take a look at some other market leaders. Mid-caps, thus far constructive. Came back to an upward sloping 20-day in blue, and during Friday's session made a stand. Similar situation with economically sensitive home construction stocks. The moving average cluster for value stocks, blue, the fastest moving averages on top, prices above all of the moving averages, and the slopes of the moving averages look like they're trying to turn back up. This looks quite a bit different than this period in here in 2022. Small caps above a tight cluster and thus far holding above the 20-day. If we drop below the 20-day, that's not the end of the world. Why it's relevant now, this looks like a strong trend on Friday. Makes it very, very easy to leave this position alone as of Friday's close. The pullback in a market leader, semiconductors, thus far hasn't even come back to an upward sloping 20-day. Same can be said for economically sensitive SP high beta and the S&P 500 index, in this case in the form of VU. Still a lot of talk about the yield curve. We should keep in mind it's relevant. It's also relevant that the economist that identified the yield curve as being useful is saying he thinks it may be flashing a false signal. Even a laggard off of the low XLK is still holding above the moving averages in a constructive manner. Some of the action in foreign stocks tied to currencies, so they may be more vulnerable to a give back here. Foreign value right now hugging that upward sloping 20-day. And again, the 20-day in and of itself is not that important relative to an uptrend. It's one of many reference points. Concerns would increase if price slashed through the moving averages and moved into this area here. Consumer discretionary back to the 20-day above the moving averages, holding this breakout above this level and holding above this level. These are bullet points from the November 18th video where we highlighted the importance of tape reading in this environment. Even after many markets bottomed in October of last year, there were still signs of risk aversion all over the tape in Q4 of last year, including the Nasdaq printing a new low for the bear market on December 28th. Very difficult for new bull markets to start if the Nasdaq is still printing new bear market lows. And that's the case whether the Nasdaq is going to be a leader or a laggard in a new bull market. It still needs to settle down. So let's quickly walk forward from this date and try to understand how we got to early to mid-February 2023. Very early in the trading year, January 4th, things started to improve on the tape. And that carried through to January 6th. And in that January 6th video, we covered this chart of the Nasdaq dated January 6th. In this chart of the Dow dated January 6th. And you may remember, we said most likely one of two things were going to happen. We still had a battle going on between the bulls and the bears. And if we were going to make new bear market lows, most likely the stronger chart, the Dow, was going to begin to morph into something that looked more like the weaker chart, the Nasdaq over here on the left. Or, if this low was going to hold, the laggard, which just made a new low, needed to right itself, and this chart needed to start to morph into something that looks more like the Dow over here. So keep in mind, on January 6th, this is the 250-day moving average right here for the Nasdaq. The Nasdaq has not made a serious run at staying above the 250-day, really at any point in calendar year 2022. Contrast that with the Dow that had been above the 250-day for several weeks. If we look at the same moving averages on February 9th for the Nasdaq, you can see it does look better. It does look different. It doesn't look great, but it looks better. Unlike all of 2022, when we couldn't make a run at this moving average here, we've cleared it on a closing basis. Here, the 50-day in blue's turning down. Here, it's trying to turn back up. And maybe most importantly, at this point, the Nasdaq has stopped making new closing lows. Doesn't mean it's not going to make one going forward, but it hasn't made one in several weeks now. In fact, it's made a relatively important higher high, clearing this high here. So we said we wanted to see signs of improvement relative to risk acceptance, relative to risk aversion. Started to see that in early January. Seen some moderate improvement on the chart of the Nasdaq. And this chart's dated December 30th. There were things that we wanted to see on these charts, something like this or this, and we have seen them. This is dated February 3rd. Similar situation here, dated January 6th. We said we wanted to see something more like this over here, and for the most part, that's exactly what we got as of February 3rd. This is economically sensitive high beta stocks. It has a higher weight to technology and a higher weight to consumer discretionary for the most part than the standard S&P 500 index. This is that risk-on look here in Q4 of 2020, and this is what the chart looked like during 2022. This was the look on February 2nd. You can see it's quite a bit different than anything that we had seen looking back several months. And this looks quite a bit like this going back to Q4 of 2020. And this relative strength here is important because it speaks to economic confidence relative to economic fear. Thus, in terms of reading the tape for the first few weeks of January, much improved relative to Q4 of last year. And since we're using a weight of the evidence approach, it's also relevant that the score on this system here between 0 and 100% improved significantly in recent weeks, and the trend strength portion of the market model has also improved significantly. This is unbiased evidence that speaks to an attempt to make a permanent low, and the scores within the market model speak to improving trends. And as we discussed last week, you really don't need numbers to see the improvement in the trend on this chart here, the equal weight S&P 500 as of February 3rd. This looks quite a bit different relative to anything in here in calendar year 2022. As we discussed last week, we also got a weekly close above 4072, which is a constructive look here relative to the 30-week moving average. And for several months, we've been looking at these levels on weekly RSI and these levels on weekly TSI. And last week, we saw something that we never saw in calendar year 2022. We cleared those thresholds on a weekly basis. So as we've just reviewed, we've seen quite a bit of improvement walking forward from November 18th and really walking forward from December 28th, late last year when the NASDAQ printed that new bear market low. Do we have anything else in hand that speaks to the probability of good things happening relative to the probability of bad things happening? The answer is yes. We covered this study on January 27th. After similar signals in the past, really good things happened in the S&P 500 looking out 1 to 3 years. Also covered this data set on January 27th. And for the most part, when something similar happened in the past, good things tended to happen in the stock market. This chart of the NYSE Breadth Momentum Oscillator is dated February 8th. And in all the charts and cases that follow, we'll be covering signals that occurred recently, sometime in the past few days or past few weeks. Looking at a weekly data set in this case, data going back to 1982. It is rare to see an oversold condition down here hitting the lower blue line. This is 1990. It's rare to go from the lower blue to the upper blue, which we hit in 1991. Going back to 1982, it happened one previous time, after the major low in 2009. This too is after a low in the stock market. The third time, dating back to 1982, occurred recently in 2023. And these concepts apply to every chart we're going to cover. Technical analysis tracks the past. It does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders, and that past activity was able to push the market from a very rare oversold condition, relatively rapidly in this case, to a very rare overbought condition. So we have to use our own intelligence to draw conclusions about what the past activity, this move right here, may say about the future activity of other traders. Looking back to 1982, the future activity of other traders pushed the markets higher. Roughly 15% higher a year later, roughly 33% higher 2 years later, and somewhere in the neighborhood of 37 to 38% higher looking out 3 years. And that's 3 years from this point here, 3 years from this point here, which is similar to something that just happened in Q1 of 2023. NYSE stocks greater than their 50-day exponential moving average. We only have data going back to 2002. We're using all of it. Similar concepts here. Rare move from A to B. Only happened a handful of times, and you can see subsequent historical performance was very impressive. This data is tied to the 50-day exponential moving average on the NYSE. In the present day, we have some noticeable divergences when we look at data for 50-day moving averages and 20-day moving averages. And while that is relevant and somewhat concerning, common sense tells us if we get a breadth thrust and we move from a rare oversold condition to a rare overbought condition, it wouldn't be unusual to have a divergence as the stock market's rising, because this is a rare level. So when we look at this data for 50 days and 20 days, it's within the realm of reason to get a big divergence as price rises. Here's another example. Greater than their 50-day moving average here, dropping. S&P rises for several months. Remember, we're using a weight of the evidence approach. This data is tied to the NYSE. This data is tied to the NASDAQ. NASDAQ stocks greater than their 200-day exponential moving average, rare move. Historically, very impressive subsequent S&P 500 performance. A little bit different twist on this data. It's also a daily set. We have data in this case going back to 1980. Only seen similar signals in 82, 91, 2009, and 2020. If you know your market history, you know those were excellent longer-term entry points. So this data is tied to common stocks only on the NYSE. It takes out other instruments. A move from A to B, something that we just saw in 2023, it's only happened a handful of times. After the major low in 2009, you hit the top line. After the major low in 2011, you hit the top line. After the major low in the S&P 500 that occurs in February, you hit the top line in March. The COVID low is in March. You hit the top line in 2020 in June. And after that, good things still happened. So this is significant improvement in breadth data. And this is significant improvement in breadth data relative to what we saw here in 2022. Same concepts here. This data is tied to the S&P 500. This looks different from all of this. Technical analysis can be about subtle shifts. This is the beginning of 2022. You can see the data set never drops below the blue line until recently. Doesn't mean the low was in, but this is what you want to see after a low is in. It's a step in the right direction. It's better than anything back here. Have data going back to 1996. Only happened 2 previous times, after the major low in the S&P 500 in 2009 and after the major low in the S&P 500 in 2020. Third time, early 2023. And in this case, the past activity of some traders said quite a bit about the future activity of other traders. Average gain in the S&P 500 2 years later, just a hair under 48%. We've seen data tied to the NYSE with common stocks only, the NASDAQ, the tech sector, and with broad participation, not surprising to see a data set tied to the Dow Jones Industrial Average. Percent of Dow stocks greater than their 150-day simple moving average. Once again, we have data going back to 2002. We're looking at all the data here after a major low, here after a major low, here after a major low, and we just did something similar in 2023. And note, it's relevant. You're moving from down here, a rare oversold condition, to here. That never happened in 2022. We never came down here and moved back to here. And in this case, the gains were also impressive walking forward. We're looking at gains for the S&P 500 index in all cases just to keep things consistent. Earlier, we covered NASDAQ stocks greater than their 200-day exponential moving average. Very similar concepts here. This is NASDAQ stocks greater than their 50-day simple moving average. And once again, you can see the concept here of a divergence. Here's the low in the S&P 500. Look how high the indicator is here. It basically is in divergence mode here relative to this high for this entire move in here. Similar concepts here. Way up here in 2003, the S&P 500 moves from point A to point B. And relative to the initial high off the thrust, this is a big divergence. Divergences are always relevant, Just a question of how relevant. In the past, how did stocks perform when they went from point A to point B? Average gain 3 years later, almost 49% in the S&P 500 index. The data that we've looked at thus far is tied to the broad NASDAQ Composite Index. This is tied to the narrower NASDAQ 100 Index. NASDAQ 100 stocks greater than their 200-day simple moving average. Same concepts, rare move. What does the past activity of some traders tell us about the subsequent activity of other traders, in this case, since we're looking at historical data? The table speaks for itself. Different data set tied to the NYSE. NYSE stocks greater than their 150-day simple moving average. If you know your market history, this is a good date, this is a good date, this is a good date, and this is a good date. Something similar just happened early in 2023. And if history repeats itself, which is to be determined in any shape, form, or fashion, then good things could happen. Have to be open to much better than expected outcomes looking out 1, 2, and 3 years. We looked at data tied to the broader S&P 500. This is tied to the narrower S&P 100. Very similar concepts, very similar subsequent performance. In this case, we only have data going back to 2010. This is S&P 600 small caps, new highs minus new lows percent. Rare to go from the lower line to the upper line, lower line to the upper line. We just did it, hit it in 2023. In the two previous cases, good things happened in the stock market. Average gain looking out 2 years was 22%, 3 years, 45%. This data set's tied to small cap stocks, exact same concepts using data tied to the S&P 500. And as you might imagine, the performance was impressive walking forward in the historical cases. Walter Deemer's a retired Wall Street analyst. He has a ton of experience and he's seen a ton of different markets. Tweet from January 12th. This is a genuine breath thrust. It means, in my humble opinion, we're in a bull market. The signal he's talking about has only occurred 25 times dating back to 1945. And Walter, on his Twitter feed, had this study here from the Twitter handle here. It basically says the market action that we've seen in the rear view mirror relative to last year and relative to what we saw in January, here's the precedent. And it's easily one of the most lopsidedly bullish tables I've ever posted. Average and median maximum 12-month return after something similar happened in the past, 25%. You can see here all of these green. There's no red over here looking out 12 months. Something similar has only happened 10 times, and in every case the market was higher a year later. Doesn't predict anything, simply speaks to odds. Source of this data here, here's the Twitter handle over here. This was posted on January 16th of this year. Thursday was the first time ever that a 770, a Deemer breakaway momentum, and a Whaley thrust all happened on the same day. There have been 7 instances where 2 of the 3 triggered on the same day. They can all be found in the table below. So conceptually, what happened in 2023 is better than what's in this table because we got all 3 instead of 2 out of 3 all on the same day. Looking out a year, very similar results to the previous table. Basically a 25% gain, average and median, 100% of the cases higher 252 trading days later. And look at the years. 1974, that's after a major bear market, 1973-74. 1982 appears twice in here. That's the start of an 18-year secular bull. 2012 is on the other side of a very volatile period and a major low in 2011. 2019, close proximity to the December Christmas Eve low in 2018. And 6/3/2020 is after the major COVID low. It's also good to keep in mind it's possible that liquidity, global liquidity, is starting to shift or will shift soon back into the market's favor. And common sense tells us that if liquidity keeps drying up and interest rates keep rising, that the interest on the national debt is going to continue to rise. It really doesn't matter which way you look at it. This is a log scale over here. In this case, going back to 1980. If we look at it on a traditional scale, that's what it looks like. Tweet from Ryan Dietrich citing some work from Ned Davis Research. Can't get much more direct than looking at demand and supply. Last time we had a crossover like this, after the major COVID low. Historically, when something similar has happened, average return looking out 2 years, somewhere in the neighborhood of 35%. You may remember in recent weeks, a lot of the setups that we're seeing or action in the tape or the acceptance of risk relative to risk aversion over here in the present day does look a lot like Q4 of 2020, this period in here. That aligns well with this Ned Davis Research tweet dated February 9th, 2023. Got the strongest tape since 2020. You can see this is the period right here. It's the same period we've been referring to. This is Q4 of 2020 in here, coming out of that breakout look here in November. That's this window right in here. This is what it looks like on this relative chart. This is what February 2nd looked like on the same chart, breaking away from a very tight cluster of moving averages with the fastest moving average on top and all of the moving averages turning up. This profile is similar to this profile, except in its present form here, it looks better. So there are some specific things that we were looking for, we wanted to see happen, including the NASDAQ making and maintaining a low. Wanted to see the tape improve. Wanted to see some improvement in trends. Have that. Have it on this chart. We wanted to see signs that the tolerance for risk, taking on risk, was improving relative to being defensive. We've seen a significant shift, a shift that's very, very similar to periods where after that good things happened in the S&P 500. Asset class behavior improved. Tape in general improved. Models have improved significantly. You can see improvement here on this chart. We've cleared thresholds that are difficult to clear within the context of an ongoing bear market. And we have a mountain of evidence in hand tied to things that just happened in 2023 that tell us to be open to much better than expected outcomes. And all of that is reflected in our allocations in early to mid-February. It's also noteworthy, relative to the thrust that we saw last year, these are much stronger. Here's the level in the present day. This is the level last year. Also noteworthy, when we covered those signals last year, with the benefit of hindsight, the only thing that happened was the drawdown was larger than a typical drawdown historically. It was a rare drawdown after these signals. But if the low is in, those signals are going to be useful. When this signal comes in June or July of 2020, and you say the market was higher a year later, given what we know today, there's a good chance that the market will be higher a year from June and July of 2022. It appears that the signals that we saw last year were the early stages of a bottoming process. We always want to keep an open mind about a wide range of outcomes, so it's extremely important to acknowledge some concerns heading into CPI week. If you study bear markets relative to weekly clouds, it's not unusual for market leaders to start painting a bullish picture on the weekly clouds. VGK can still check all of these boxes. But if we're in the context of an ongoing bear market, as you might imagine, there's a buck coming. The leaders can show improvement on their weekly clouds, and the market itself, typically the S&P 500, never takes on that type of hopeful look. So this is the S&P 500 index weekly cloud as of the close on February 10th. There's work to do here, and as we've mentioned in previous videos, this is potential weekly cloud resistance in here, something we have not cleared yet. So a reversal and a drop below blue and red would add to our concerns. In terms of the weekly chart for interest rates, what we've recently seen thus far looks like a counter trend move, rates falling within the context of an uptrend. You can see we can still check all of these boxes for the 10-year yield on the weekly chart. As of Friday's close, we can't do that on the daily chart. So the question becomes, will this act as resistance for interest rates next week, or will interest rates get to the other side of the daily cloud, allowing interest rates to resume their weekly uptrend? Similar situation with the dollar that impacts countless decisions in the investment markets. The daily cloud has work to do. Can't really check a lot of these boxes. Similar to the 10-year yield, the weekly cloud of the dollar is showing some weakness. So we have green below price, we have blue below red, but price this week trying to bounce at a logical area. This is potential cloud support here. So price still above the cloud, and the cloud is still green. So we've got a battle between the weekly and the daily. Longtime viewers and clients may remember off of the COVID low, the S&P 500 moved into a moving average cluster, and for the most part consolidated either in the cluster or above the cluster, and that tended to lean bullish. So from a guidepost perspective, this is the S&P 500's 30-week in blue, the 40-week in red. You can see they intersect right here, somewhere in the neighborhood of, let's call it 39.40-ish. Most of your leaders are consolidating higher in terms of price. The S&P's chart, a laggard, looks a little bit weaker, but all things being equal, your guidepost here is these moving averages, the weekly breakout in the same general area, and these areas in here that have acted as support and resistance in the past. So at the end of the week, you can see weekly momentum still looks good here. Weekly momentum on Microsoft looking pretty good. Not the case for some other tech stocks. Microsoft's back above the 40-week. This is a nice look here on weekly momentum. Last week, the S&P 500 closed over 4072. Thus far, we are getting consolidation above these levels. If you're a stock market bull, that's what you want to see. It's not abnormal. Giving up all of this and moving into this area would be concerning. And as we know, if we move into this area here, the longer we're there, the more concerning it would become. How is it possible that the market's trying to start a new uptrend in the face of all the fundamental concerns? Well, there are numerous reasons, but demographics near the top of the list. We showed numerous daily charts that didn't have a lot of damage. For the most part, all of the breakouts that we've seen are holding, including the weekly chart of the S&P 500 up here, still trying to make a stand above an upward sloping 200-week, which aligns with that secular bull market demographic theory of a secular trend. Also noteworthy, weekly momentum down here still looks good for the S&P 500 index. In fact, if you look at this closely, price here, this is where the market failed in August of last year. Price is quite a bit higher still relative to this high here. We've got a bullish weekly RSI divergence. RSI here last week higher than the close here in August, even though price is quite a bit lower still. This is also a nice look here, telling us to keep an open mind about the stock market holding the upward sloping 200-week and holding this breakout. Similar situation here. The S&P 500 was down this week, but we've been watching weekly TSI momentum. We still closed above zero on February 10th. The longer we stay there, the more relevant it becomes, and the more it starts to distance itself from 2008, where we couldn't do that, and 2002, where we turned down before closing above the zero line. Similar situation with the RSI. This level, this previous level here in 2022. Last week we closed above all those levels. We still held it, closed this week at 55.24. Also noteworthy in the credit markets here, still hovering around a new all-time high on Friday. BKLN leveraged loan ETF was up on Friday. Price above all the moving averages, trying to morph back into a full-bore bullish look. There's also a good look here on the weekly Bollinger Bands. This looks different than anything we can see in here. Ratio holds here, S&P 500 peaks, holds here, S&P 500 peaks, holds here, S&P 500 has a give back. This looks different, and it didn't change in a significant manner this week. The interpretation would change significantly if this ratio moves out here and stays there. Right now, still looks like a bearish breakdown in favor of the bullish case. Shown these levels in the past, SPY holding above the downward sloping trend line and holding above these areas here. Also above the 200-week moving average that's starting to flatten out, and the 50-day moving average that's now back above the 200-day, something that never happened in this window. Nasdaq was down on Friday, but this is still a constructive look with the moving averages and volume by price. There's a description of this chart on our Twitter feed at Shivako Capital. You can look at it in more detail. This is a constructive look here. SP low volatility divided by SPY. The fastest moving average, the 20-day, moves rapidly from the top of the moving average cluster to the bottom. This is as of the close on Friday, February 10th. Moves rapidly from the top to the bottom. This is after the COVID low. That's a risk-on look. The polar opposite. Fastest moving average turns up and moves from the bottom of the moving average cluster to the top in a relatively rapid fashion. When does that happen? That's a risk-off look, as the stock market's peaking in Q4 of last year and Q1 of this year. No significant change this week. To review some back-of-the-envelope keys for next week. We'd like to see the constructive looks from leaders on the weekly clouds hold. We'd like to see the S&P 500 continue to consolidate up here in a constructive manner relative to the 30 and 40 week. We'd like to see breakouts on numerous time frames and in numerous markets hold. We'd like to see this upward bias and weekly momentum remain in place. And from a tape reading perspective or acceptance of risk perspective, we want a wide range of charts and ratios to remain in risk-on mode, as this chart is on February 10th. If the market decides that it's wrong next week, most of these charts that we've been covering will shift in an abrupt and concerning manner. And we all know the only way that we can handle that type of shift properly is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.